Hello, Internet friend. Today on Value Side, the real reason the Fed lowered interest rates. I'm David Ravel. Well, like an umpire in baseball or the referee in football, Federal Reserve Chairman Jerome Powell strode to the podium and recited the rules to this game. He does this every time he gives a press conference or a speech. Quote, "My colleagues and I are squarely focused on achieving our dual mandated goals of maximum employment and stable prices for the benefit of the American people." Unquote. Educated as a lawyer, Powell says, "See, we did what you asked us to do." But this time the words seem to ring hollow, creating confusion and perplexity among the analysts on Wall Street. The analysts' reasoning went like this. If the Fed's goal are stable prices, with inflation goal of 2%, and steady employment, then why isn't the Fed fighting higher prices, inflation? Fighting inflation would mean that the Fed would look to raise interest rates, not lower them. Currently, inflation, as measured by its most widely followed indicator, the Consumer Price Index, is rising, not falling. In November's reading, the CPI was up to 2.7%, after reaching a cycle low of just 2.4% in September. Underscoring this rise in inflation, Powell goes on to say that core PCE prices, the Fed's preferred measure of inflation, are rising at 2.8%, even higher than the CPI level. At this point, we're all on the same page. Inflation is the problem, and the Fed ought to fight it. It's then that Powell pulls the rug out from under all of us. At today's meeting, the committee decided to lower the target rate for the Fed funds by 0.25% to 4.25%. Unquote. Wait just a minute. As any first-year econ student knows, lowering interest rates contributes to inflation. It doesn't curtail it. This move is inexplicable. It makes no sense in a world where inflation is rising. Wall Street was gobsmacked. The bond market went into a tizzy. The market commentators wrote long screeds about Powell's misreading of the financial markets. However, like most things in Washington, Powell's move had less to do with finance and economics than with politics. And to appreciate that, you have to go back to the origin of Powell's rules of the game. Where did the twin mandate come from? And why are the Fed's chief goals full employment and stable prices? To understand the twin mandate, we have to go back nearly half a century to the time of one of the most clever politicians of that era, Hubert Humphrey. Humphrey was a self-styled man of the people, a populist from Minneapolis. Humphrey did not trust the Northeast bankers. He felt that the brokers and bankers from New York and Boston had too much influence over our economy to the detriment of everyday people. At this time, the nation was suffering from the twin ills of high inflation and high unemployment. Humphrey thought it was time to put the nation's central bank, the Federal Reserve, on the task of addressing those two problems. So he, along with his colleague in the House, Augustus Hawkins, wrote the Humphrey-Hawkins Bill, which was later passed into law. This was the law that the mandate, the Fed's twin goals of full employment and stable prices, came from. Now, the new law also cleverly removed the federal government's primary responsibility for full employment, which it had had for the last 32 years, and now placed that goal squarely on the shoulders of the Federal Reserve, while adding stable prices to their goal. What a remarkable tour de force. Humphrey could remove himself and his fellow legislators from the responsibility for full employment and hand it over to the bankers, the very ones he didn't trust. The new law also very subtly set a trap for the Federal Reserve, one that Jerome Powell stepped into this week. Ask any banker before the Humphrey-Hawkins Bill, now called, incidentally, the Full Employment and Balanced Growth Act, what the primary function of the central bank should be, and they'd no doubt answer, to maintain a sound banking system. That is, ensure the nation's banks are healthy and strong. Unfortunately, today we find ourselves in an environment where fighting inflation conflicts with the bank's balance sheet. Let me explain. Banks, broker-dealers, insurance companies, and other financial institutions are required to maintain certain minimum levels of capital. I'm most familiar with the broker-dealer capital requirements, but the principle behind all of these computations is the same. Most banks hold their capital in U.S. Treasuries, the highest rated of all available investment options. A look at the capital account of most banks will reveal a number of U.S. Treasury bills, notes, and bonds. Generally, the bank will calculate its current capital position by adding up the current quote of all the portfolio of its U.S. Treasuries and any other capital positions it might have like cash or corporate bonds, taking the appropriate adjustments and providing its regulator with the current capital position of the bank. But here's the rub. As any bond investor knows, the past couple of years have been one of the worst bear markets ever in bonds. Remember, the price of a bond is inversely related to its yield. As yields rise, the price of the bond falls. So what happens in the last couple of years that caused this major bond market bear market? Of course, the Federal Reserve raised interest rate, the most in history. The effective funds rate went from less than 0.25% to over 5%. In Powell's pronouncement this week, the Fed reduced the rate back to 4.25%, but still substantially above the level of just a couple of years ago, and it has had a devastating effect on the bank's capital account. Let's assume that your bank purchased a 5-year Treasury note in January of 2022, just before the Fed started raising interest rate. The bank paid $1,000 for that note, and their yield was roughly 0.3%. Assuming the bank still holds that note in its capital account, what's the current price of that same note? Well, it's declined to about $750. That's a 25% loss. Now, if our imaginary bank holds many of these bonds or notes, the chances are overwhelming that it is now undercapitalized. And I believe this was the real reason that Silicon Valley Bank went out last year. We can see the effects of higher interest rates have had on the depository institutions as the Federal Reserve publishes a monthly report on those capital reserves. Reserves for the industry have declined from $4.1 trillion in December of 2021, before the Fed raised rates, to $3.2 trillion currently. That's a decline of approximately $900 billion, due almost entirely to the decline in the capital accounts in this rising interest rate environment. This is also why Chairman Powell was forced to reduce interest rate. Had the Fed chosen to continue raising rates, as Wall Street expected, it's likely that several major banks and other depository institutions would have closed. For now, the Fed's fight of inflation will have to take a back seat to its effort to preserve member banks' capital accounts. Perhaps it's time to amend the twin mandate to something that more closely replicates the reality of maintaining the bank's industry's viability. And that's today's Value Side. For all of our articles, references, and podcasts, visit valueside.com. I'm David Ravel. ValueSide is independently written and researched. The views expressed are strictly my own.